The U.S. tech stock market in early 2026 tells a very different story from the boom and bust cycles of previous years. Instead of moving as a single block, tech stocks are now splitting clearly into winners and losers. Some companies are being rewarded with strong valuations and steady investor confidence, while others are struggling despite being part of the same broader technology sector. This divide reveals what the market now values, what it is actively penalizing, and how the definition of a strong tech company is changing. One of the biggest winners in early 2026 has been companies tied directly to core AI infrastructure. Chipmakers, data center suppliers, and firms providing essential components for AI workloads continue to attract capital. Investors are no longer betting on abstract AI potential. They are focusing on companies that sell tangible products or services required to run AI systems at scale. These businesses benefit from long-term contracts, predictable demand, and high switching costs, which make their revenues feel more durable, even in an uncertain economic environment. Cloud infrastructure providers have also performed relatively well, but with an important distinction. The market is rewarding cloud companies that show disciplined cost control and clear paths to profitability. Pure growth narratives are no longer enough. Investors want evidence that cloud spending can translate into stable margins, not just rising revenue. Companies that successfully optimize data center efficiency, manage energy costs, and reduce customer churn are outperforming peers that continue to chase expansion at the expense of financial discipline. In contrast, many consumer-facing tech companies are struggling in early 2026. Hardware makers that rely heavily on discretionary spending are facing slower growth as consumers delay upgrades. Smartphones, wearables, and personal electronics are lasting longer, and incremental improvements are no longer compelling enough to drive frequent replacement cycles. Tech stocks tied to these segments have seen pressure on both revenue growth and margins, leading investors to reassess long-term expectations. Software companies are experiencing a similar split. Enterprise software firms that solve clear operational problems, such as cybersecurity, compliance, and infrastructure management, are holding up well. These products are viewed as necessities rather than optional tools. On the other hand, software companies built around productivity enhancements, experimentation, or overlapping features are underperforming. Businesses are consolidating software spending, reducing redundant tools, and demanding clearer return on investment, which directly impacts valuations. Another group facing challenges is advertising-dependent tech firms. While digital advertising has not collapsed, growth has become more volatile. Brands are scrutinizing ad spend more carefully, shifting budgets toward measurable performance rather than broad reach. Platforms that cannot clearly demonstrate conversion value or pricing efficiency are being penalized. Investors now view advertising-heavy revenue models as more cyclical and less predictable than previously assumed. One of the most important drivers of the early 2026 tech market is interest rates. Even if rates stabilize or decline slightly, they remain far higher than the ultra-low levels that fueled aggressive tech valuations in the past. Higher rates change how future earnings are valued. Companies promising profits far into the future are less attractive than those generating strong cash flow today. This environment favors mature tech firms with proven business models over speculative growth stories. Capital discipline has become another major theme shaping winners and losers. Companies that demonstrate restraint in hiring, capital spending, and acquisitions are being rewarded. Investors have grown skeptical of tech firms that expand aggressively without clear efficiency gains. Stock prices increasingly reflect management credibility and execution quality, not just market opportunity. This shift represents a fundamental change from the growth at all costs mindset that dominated earlier cycles. AI, while still a powerful market driver, is also becoming more nuanced in how it affects stock performance. Simply announcing AI initiatives is no longer enough to boost valuations. Investors now ask specific questions. Does AI reduce costs? Does it increase pricing power? Does it improve customer retention? Companies that can answer these questions convincingly are outperforming those that treat AI as a branding exercise rather than a business tool. Regulatory pressure is another factor influencing tech stocks in early 2026. Antitrust scrutiny, data privacy rules, and AI governance frameworks continue to shape how companies operate. Firms that proactively adapt their business models to regulatory realities are seen as lower risk. Those that rely on regulatory loopholes or aggressive data practices face valuation discounts, as investors factor in potential legal and compliance costs. Geopolitical and supply chain considerations are also playing a role. Tech companies with diversified manufacturing, resilient supplier networks, and strong domestic infrastructure exposure are viewed more favorably. The market has learned from recent disruptions that operational resilience matters as much as innovation. This has shifted investor attention toward companies that can deliver consistently, even under external pressure. Perhaps the most important takeaway from US tech stocks in early 2026 is that the market is no longer treating tech as a single category. Performance depends on fundamentals, execution, and strategic clarity. Winners are companies that provide essential infrastructure, generate real cash flow, and operate with discipline. Losers are those that rely on outdated growth assumptions, discretionary spending, or vague narratives. Looking ahead, this environment suggests a more stable but less forgiving tech market. Volatility still exists, but it is driven by company-specific results rather than broad sector enthusiasm. For investors and industry observers, early 2026 highlights a new phase for US tech stocks, one defined by selectivity, realism, and a sharper focus on long-term sustainability over hype-driven momentum.